The strategy of dividend investing has a large compounding effect, especially when investors are consistent with contributions and reinvest dividends. I'm going to show the true power of dividend investing by modeling years of stock growth as well as dividend growth. People usually get discouraged or frustrated due to a lack of early results in their investments. I want to explain how dividend investing can be your ticket to financial freedom and generational wealth. To visualize dividend investing, I've built a dividend model of TD Bank over the last 20 years. This Canadian bank has a historical reputation of raising its dividend consistently. To make this model, I took the historical statistics of the stock and projected them into the future. I used the historical compound annual growth rate, also known as the CAGR, of the dividends based on the last 25 years, which was 11.3%, as well as the CAGR of the stock based on the last 10 years, which is 7.7%. Let's see how $1,000 performed in the last 25 years while reinvesting dividends. Your investment would have grown over $22,000. Without reinvesting dividends during the same period, you would have only received $6,400, though you would have received $4,300 in cash through dividends, for a total value of about $10,700. In this case, reinvesting dividends increased returns by over double. This is due to the compound effect dividends possess. Every single dividend payout, the investor can buy more shares, increasing the next dividend payout, increasing the amount of shares you can buy next, increasing your payouts even more, and so on and so forth. By the end of 25 years of reinvesting your dividends, you'll be earning $1,500 every year through dividends, and this is over 150% of your initial investment every year. From there, you can choose to continue reinvesting your dividends or use them for other expenses. Even if you stopped reinvesting, your payout will continue to grow because TD will continue to grow their dividend. A more complete investing approach would include regular contributions. So let's consider an initial investment of $1,000, but also contribute $1,000 each and every month. This form of investing would produce a position value over $2.1 million when reinvesting dividends over 25 years, and only $846,000 when not reinvesting, but would produce a balance of $462,000 through dividends for a total of about $1.3 million. This is due to that same compounding effect. A very impressive statistic is the annual payout after 25 years. The investor would receive $142,000 in annual dividend payouts after the 25th year is complete. This is 51.8% of your total contributions during the 25-year period in just one annual payment. Compare this to only $63,000 when you don't reinvest, which is only 44% of the income you would have had. The longer you go through this reinvestment process, the stronger the compounding effect is. So what happens if you continue to reinvest your dividends for more years? After 30 years of reinvesting dividends while contributing $1,000 monthly, your total would grow to over $4.7 million with an annual income of $390,000. After 35 years, the total would be over $11 million with an annual income of $1,065,000. We can see how powerful the exponential growth can be when dividends are reinvested. There are other advantages such as tax breaks and liquidity advantages that also come with this type of strategy. For example, the first $50,000 earned as eligible dividends in Alberta are taxed at 2.5%, but this will vary depending on the area you live in. It is important to note that eligible dividends are taxed more aggressively after the $155,000 mark, and an investor may want to add other investing strategies that don't create frequent taxable events. Dividend investing is a dependable approach that can provide substantial gains if done right for long periods of time. There is no timing the market or looking for the next hot stock. The plan of this strategy is clear-cut with no tricks and can be done by anyone.